Let me talk about tariffs now. The high tariff rates, highest since the Depression era, right? With the revised Liberation Day tariffs, 90-plus countries. Another big story today as they officially take effect, and they're adjusted from the original reciprocal tariffs rolled out 2nd of April. Baseline 10%, but going much higher for countries that didn't get a deal with President Trump. And there could still be more changes to come. U.S. trading partners continue to lobby for exemption. Some of the details on existing trade deals have yet to be worked out. We want to bring Brandon Daniels in on this. He's joined us many times to talk about this, the CEO at the firm Exiger, which is an AI supply chain firm. And I point that out not only to identify your company, Brandon, but because that's what we always start with when we have a new world kind of coming into effect. And whatever you think of what Trump's doing, if you think it's too high, too low, what's the impact of it? Like, how do supply chains change now? Now we know the rates. What's the how has the world changed?
Connell, it's good to see you. Thank you for having me on. I think we are still in a period of flux and negotiation. I think when we started this process, everyone thought that we would end up with these high tariff rates across the world that would be imposed. But what we saw with Japan and EU, and if you look at sort of the inflationary pressure we've seen in the EU deal, those are actually wins, right? We've lowered the cost of importing into Europe and actually opened up a European car market. We've opened up Japanese markets, and the tariffs, and by far and large, economists are saying, look, these are sort of tariffs that we can withstand, that aren't going to have a significant impact.
What's a number we can withstand, by the way, mostly for countries? Like if you say go 15, it's like it's high historically, right? But you're saying it's because of the other side of the deal that we've cut, we can maybe withstand a lot of those numbers if it's say 15.
Yeah, I mean, the overall economic growth from opening up some of these markets is significant. And so I don't think you're going to see the GDP slowdown that people anticipate seeing, and like the Yale study had said that you might see. I don't think you're going to see that GDP slowdown because of the reciprocal opening up of markets.
Well, it costs regular people. That's what they also said at Yale. They were like, oh, it's like $2,400 for the year or something like that on average.
I don't think all of those costs will be passed on to consumers. There are a couple of really big highlights, though, like what are going to be the cost impacts to India? And are those India tariff rates going to stay at those elevated?
Well, we don't know if he'll really stay at 50 with India. I mean, that's clearly meant, he's trying to go after Russia with that. So, and that kind of brings up a larger question for someone like you. The first question I asked, I think it's interesting that you went right to saying, well, we're still kind of in a negotiation period. Of course, Trump started all this off, no exemptions and all that, but now there are a number of them, like the Apple, like the semiconductors. You invest all the money like Apple did, don't worry about those chip tariffs, and there's more of that. So for people you deal with, like on the company level, is it still wait and see, or will they hold off on like redoing their business or reworking supply chains and that kind of thing?
So I think people are starting to rework supply chains, and specifically in high-end technology, you actually have the ability to rework those supply chains. A lot of the global advanced semiconductor manufacturing move to the United States or sits in allied countries or is subject to these modifications.
So that incentive works, in other words, like what Trump's doing there, right? So he's bringing it back. So if you're like Taiwan Semiconductor, huge company, so you go, instead of making those little chips in Taiwan, you make them in Arizona. So it's still the same company, but now they're American-made chips. So that you think is working, and that is a supply chain change.
It is working, and the global demand is significant enough to consume both, chipsets. And the level of automation and artificial intelligence that we're seeing in supply chain, like with companies like ours, that is making it so that these, new sites can be cost effective. I mean, you and I spoke about this at the beginning of this tariff strategy. The fact is that there are parts of North Texas that have very cheap land that are deregulated, and the cost of these sort of like new robotics capabilities that can run manufacturing floors, those are going to be flat no matter where you are in the world. So we actually can lot of significant manufacturing back to the States.
Yeah, that's interesting. So, because I think people talk in absolutes too much about this, and sometimes it's people who don't even know what they're necessarily talking about and don't have the experience, but they'll say stuff like, and these jobs are never coming back. And it may be true, correct me if I'm wrong, that some of them aren't, and maybe we don't want some of them to come back. But your point is it's not a true across the board, and because the world has changed and because of AI and all this type of stuff. So it's a little more complicated than, to me at least, from listening to you, than to just say, to broad brush the whole thing.
It's going to be a very nuanced impact, Connell. It's going to be an impact that's going to be decided over the next, several months. And not to mention, we are collecting huge tariff revenues in the meantime, right? I mean, we have hundreds of millions of dollars that are coming into the United States. And those hundreds of millions of dollars, if they're coming in while we have an interest rate drop, which hopefully we start to see, sort of price, as long as prices stay relatively steady. We've seen the job softening because of the Fed keeping those rates high.
Yeah.
If those rates come down and we're collecting that much tariff revenue and we can start to bring down our debt payments, there actually is a chance for that kind of resurgence of growth. And a lot of that private equity capital, there's like $3 trillion sitting on the sidelines right now, actually pouring back into our global economy and revitalizing not just the United States, but I'd say our allies too.
Hey, that's the positive scenario, and we like positive scenarios. Outlined well. Thank you, Brandon. It's always good to have you on.
All right. Thank you so much, Donald. Good to see you.
Brandon Daniels, Exiger. Now,